What does Fed patience mean for Treasury markets?
I think it means you're very much stuck in a range, probably 240 maybe to 280. Not really going anywhere. I mean, at the moment, if you look at the kind of market expectations, okay, there's a little bit of cuts priced in. Personally, I'm not quite convinced that's going to happen later this year. So we're kind of stuck from a Treasury standpoint until we get a catalyst to push it in one direction.
Very good. I want to throw up another chart here. Iain Stealey knows this chart quite well, working with Bob. Michael, very simply here, this is the Fed expectations of a rate cut into next year. What shifted yesterday, Iain, is the September certitude became the December certitude, and there's this belief in a rate cut, a majority belief, well above 50% into next year. Do your economists suggest that's less than likely?
I think so. I think the problem with the market is the market can't just sit there with no expectation. You've either got to be looking at a hike or looking at a cut. So the reality is I think it's fair that a cut is actually being priced into the market, or a very small chance of it. But I think the reality is as we get through the back end of this year and the economic data we feel will probably get a little bit better around the rest of the world, then actually you'll have those cuts priced further and further out, which is effectively what happened yesterday, as you said.
Okay, you sound like Bruce Kasman. It's too much. Okay, Iain Stealey, what's important here is what will it mean for the markets if we drift away from a rate cut environment over 1 to 5 months? What does it do to coupon price, and what does it do to the stock market?
I don't think it does a lot to the Treasury market. As I said, I think we'll be fairly range bound. What it will do to the stock market will be dependent on whether we continue to get a bit of a pickup in economic activity. So if you do get some of that China stimulus come through, you do get an agreement between the US and China on trade, I don't see any reason why the stock market can't continue to move higher, even if you get maybe expectations of easing out of the Fed pushed back.
But Iain, if we have an inverted yield curve in the US, and I don't know what the probability of that is in your eyes, but if we do, should we take it as a bad signal, or do you ignore it because of what the Fed has done?
I think the never say never. I think historically it's always been the indicator for the recession. Now, I think there's a time lag. It's not that it means recession's happening imminently. It can be a period of a year, a couple of years, so let's not get too concerned. I do think there's a lot of other factors at the moment, quantitative easing, low yields around the world, that are having influences on long-end yields. What would be great for the Fed and what the Fed would like to see, and what Jay Powell would like to see, is actually inflation expectations pick up a bit and maybe get a little bit of re-steepening in the curve while they maintain the front end.
I mean, do you think inflation expectations pick up a bit?
I think they should do towards the back end of the year, because we had that big kind of sell-off in oil. We've rebounded a decent amount of that, but that's really going to be maybe more of a fourth quarter event. We've got wage growth coming through around the majority of the world at the moment. So what will be interesting, I think, is the growth standpoint. That's what people would really like to see. The US looks fine, the 3.2% we saw on Friday. Actually, Europe didn't look so bad yesterday. So if we can start to see that, China, the rest of the world look a little bit better through the second half, it should lead to inflation picking up.